What if an illness or injury stopped you from working tomorrow? Disability insurance can replace part of your income while you're unable to work. Short-term plans usually cover a few months, while long-term plans may provide benefits for years, depending on the policy. Compare the waiting period, monthly benefit amount, and the difference between own occupation and any occupation coverage. Premiums depend on factors like age, health, job, and coverage amount. The right policy can help protect your income and financial future. Follow for more simple insurance and money tips.
Imagine your regular paycheck arriving every 2 weeks like clockwork. Now imagine a sudden illness or injury, and that clock simply stops ticking. The cash flow vanishes, but your living expenses keep compounding. When we attempt to protect our wealth, we usually focus on physical things. We buy insurance policies for our homes and our cars, and we carefully monitor our retirement accounts. This chart shows a comparison between typical physical assets and your lifetime earning potential. If you calculate the total wages you will make over 30 years, that number mathematically dwarfs the value of your house or your car. Your ability to get up and go to work is your most valuable financial asset, and that asset is highly vulnerable. Statistically, 1 in 4 workers will experience a disability lasting longer than a year before they reach retirement age. Many people assume they are covered because their employer offers some kind of default disability plan. But relying on that basic corporate benefit as a flawless safety net carries massive financial risk. True income protection is not an automatic guarantee. It is a complex control board of specific rules, legal definitions, and modular variables that you have to actively configure. The first variable to understand is the source of the policy. Group plans cover a pool of employees, regardless of health, but they generally vanish the moment you leave your job. Individual plans are private contracts you buy directly from an insurer, designed to follow you anywhere and supplement the gaps in your employer's coverage. This timeline maps out the difference in coverage duration. Short-term disability usually replaces a portion of your wages for 3 to 6 months. Long-term disability takes over for extended conditions, paying out for several years, or sometimes all the way until you reach retirement age. Time is only part of the equation. To access those payouts, you have to meet the policy's strict legal definition of being disabled. Under an any occupation policy, you receive benefits only if you are physically and mentally incapable of performing any job you are reasonably qualified for by your education or experience, even if that job pays significantly less than your current career. If a highly specialized worker, like a heart surgeon, develops a severe hand tremor, they can no longer operate. But because they still possess medical knowledge and could technically teach or work at a clinic, an any occupation policy might pay them absolutely nothing. To protect the earning power of a specialized career, you need an own occupation definition. This rule dictates that if your injury prevents you from performing the specific duties of your regular job, you receive your full benefit, even if you choose to take a different, lower-paying job somewhere else. It carries a higher premium, but it locks in your specific earning power. The exact terminology in your contract determines whether the money flows or stops. The legal definition acts as the true trigger of your financial firewall. Once a claim is approved, you encounter another critical variable, the elimination period. This is the mandatory waiting time between the date your disability begins and the moment the insurance company actually starts issuing payments. These waiting periods can range anywhere from 30 days to 2 full years. Dragging the waiting period out to 180 days lowers the insurance company's risk, dropping your monthly premium costs significantly. However, pushing this wait time too far drains your personal savings to cover living expenses long before the first check arrives. When that check finally does arrive, its size depends entirely on how you paid for the policy. If your employer pays the premiums, or if you pay them using pre-tax dollars, the IRS taxes your final benefit payouts. A policy designed to replace 60% of your income will yield far less once the government takes its cut. Conversely, if you purchase an individual policy and pay the premiums using after-tax dollars, the benefits you receive are legally tax-free. You get to keep every single cent. Failing to align your elimination period with your actual emergency savings, or ignoring the tax status of your premiums, can leave you functionally bankrupt, even with an active policy in your filing cabinet. You can further tune your control board with modular additions called riders. A residual disability rider, for example, provides a partial income payout if you are recovering and can only manage to return to work on a part-time basis. This chart displays the overarching math behind a properly configured plan. By investing between 1% and 4% of your annual salary into premiums, You project a financial shield over as much as 80% of your total income. To build this shield, you have to actively audit your employer's group policy, identify the specific caps and tax limits, and mix in a customized individual plan to eliminate the gaps in coverage. Income protection is an active calculation. By adjusting waiting periods, defining your exact occupation, and navigating tax laws, you engineer a personal financial firewall built to preserve a lifetime of earning power.